capital markets in the United States has to do a lot with property rights and contract law and certainty of our regime, as well as wise regulation. Not the absence of regulation, which is a misunderstanding and a wrong conclusion of the last financial crisis. There was regulation prior to 2008. It did exist. Perhaps it was bad regulation that led to some bad outcomes. But just to put that as a marker down to this first question I have, which is, if you look at the world and the flow of capital around the world, Ms. Bennett, is there a rapid increase in financial regulation, and that rapid increase of regulation having an effect on the flow of capital in the world? Is that a proper understanding that regulation and capital have some linkage?
Yes, and certainly, I mean, I think the most recent sort of noteworthy study on that was undertaken by McKinsey, the McKinsey Global Institute. They brought it out, I think, in about March of last year. And what they've said is that since the crisis, since about 2007, I think global capital flows have declined about 60%. Now, some of that has to do with the crisis in Europe, which I think is an issue of government debt and placing the banking sector in an extraordinarily difficult position, and that's a separate issue. But a lot of it also has to do with the fact that following a crisis, the natural tendency of regulatory authorities, wherever they may be, is to look inward and to put barriers, and it's sort of a process I think frequently referred to as balkanization. And that makes the local sector far more insular and far more inward-looking. That's a problem because it has a real cost for the flow of capital. And one other thing I would say about that is you often hear or you read in pieces that people say it almost sounds like these flows are a bad thing, like it's a bad idea to have capital flowing across borders. But in fact, the crisis would have been far, far worse in 2008 if we didn't have the free flow of movement across borders. So that was actually, for the United States, a very big
But everyone is talking about Europe here when they testify. Financial regulators in the United States are testifying about European movements and perhaps following in a similar direction as we have in our regime. But isn't it in fact the case that with three of the world's largest banks being Chinese, that there's a movement in Asia to go a different direction in terms of regulation?
Well, first of all, I mean, Europe is an interesting case because, for example, if you take a recent initiative, and I'll use one that is in both countries, the Volcker Rule, right? Volcker Rule came out in the United States, and it's, as we know, a mammoth undertaking. It's a very complex rule. It spans hundreds of pages. It's sort of, there's a lot of micromanaging within the rule, a lot of ongoing enforcement and monitoring. And when you look at the way that the Europeans have approached, they've released a similar rule recently, but theirs is more sort of a principles-based approach. They come out and say, well, we would prefer that you didn't do this proprietary trading that has no client benefit. We're not really going to institute ongoing and expensive monitoring and enforcement type requirements. So I would argue that that's a lot less burdensome for the institutions that are following it, and that's been a consistent approach that they've adopted. There's certainly a very different approach in Asia, which is obviously certainly in Hong Kong and Singapore, which is where the main markets are, you don't see the same level of regulation. They want high capital, but they don't have the same level of micromanaging.
Mr. Halil, about crowdfunding, I authored that section of the Jobs Act that has a regime so that we can have low dollar equity raising online. You've done a study on what those 568 pages have the cost structure on a crowdfunding raise. Do the regulations have a bearing on the cost of raising money through crowdfunding?
Yeah, I mean, it took a long time to read through all those pages. It was quite cumbersome to do, and unfortunately I've had to do it a few times due to inconsistencies. But we did an analysis I included as a chart in the written testimony you're free to take a look at. But there are friction points created within the regulation that basically allow for up to 50% of the money raised going towards overhead and compliance costs. So what happens is you have an act that instead of becoming a reform act or an innovation act becomes a regulatory act with regulatory friction points. Some of them have to be changed, and that's only something that can be done with congressional support. Some of them can be changed at the discretion of the SEC with proper support given by not just Congress but other people as well. It's quite significant when you're a small business owner and you're facing upfront costs that can go easily over $30,000 without any kind of a guarantee that you can receive the capital you raised, and that's a significant debt people should not bear.
My time has expired. We'll now recognize Mr. Cleaver for 5 minutes.